Good evening, everyone. Welcome to the channel. Today I am going to talk about Cgn Mining, interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. Cgn Mining Company Limited offers a range of businesses and services, including natural uranium trading, investment in natural uranium, resources operations in the People's Republic of China, Kazakhstan, Canada, and the United Kingdom. The recent surge in Cgn Mining stock price can be attributed to a combination of factors that have contributed to an uptrend in the uranium market. Key events include the soaring uranium prices and demand due to a global shift towards nuclear energy, a new offtake agreement with its parent company setting higher fixed prices for uranium, and strategic expansion of the U.S. uranium reserve. Additionally, significant sales and purchase agreements, positive analyst upgrades, and involvement in fission uranium acquisition have also positively impacted investor sentiment. These cumulative effects, alongside a general uptrend in the uranium market, have driven Cgn Mining's stock price to skyrocket by 124.19% over the past year. The primary drivers of revenue growth or decline are largely influenced by changes in sales volume, new trade opportunities, and unit selling prices. On the one hand, revenue increase is driven by trading revenue from uranium procurement and sale, expansion of international natural uranium trading, and participation in production and sales operations. Conversely, revenue decline is attributed to a decrease in sales volume, limited new trade opportunities, and a drop in unit selling price. Net income and profit margins experienced significant declines in 2025 compared to the previous year. Net income plummeted by 160%. From $113,122 in 2024 to a loss of $67,570 in 2025. Profit margins also suffered, with gross profit margin decreasing from 1.39% to -14.44%. The EBITDA/revenue ratio dropped from 9.31% to 2.73%, and net profit margin decreased from 2.78% to -3.95%. The main reasons for these changes were a significant decrease in other operating income due to exchange losses, a decline in share of results of joint venture and associate, and an increase in selling and distribution expenses by 51%. These factors collectively contributed to the substantial decline in net income and profit margins in 2025. The company's operating cash flow status remains uncertain. A review of the financial summary reveals mixed signals regarding the company's ability to generate positive operating cash flow. While some pages suggest negative operating cash flow due to lower EBITDA and net cash used in operating activities, others indicate a positive trend based on an increase in current assets and a decrease in non-current assets that is not directly related to operating cash flow. The conflicting information makes it challenging to determine the company's true operating cash flow status. Further analysis of the financial statements is necessary to provide a clear understanding of this key metric. The company's debt level and interest expenses have undergone significant changes over the past year. Notably, total debt has increased significantly, with a substantial rise in current liabilities. However, bank borrowings have decreased from $1,519,996 to $604,896. On the other hand, loans from fellow subsidiaries have increased substantially, rising from $0 to $1,668 million. Consequently, interest expenses have also seen an increase of $22,563. Specifically, interest expenses on bank borrowings and loans from fellow subsidiaries have risen by $21,587 and $1,230 respectively. Despite this, the effective interest rate has decreased slightly from 5.13% to 5.02%. These changes indicate a shift in the company's debt structure and its associated costs. The company's financial performance varied across different segments and regions. Notably, the natural uranium segment experienced a significant loss of $161,930, while the UK and Kazakhstan also underperformed. In contrast, the other trading investment segment generated a profit of $305,571. Additionally, Hong Kong showed positive performance data. Management's outlook on company strategy. According to management, the global demand for natural uranium is expected to continue growing with the development of the nuclear power industry. This growth presents opportunities for the company to expand its operations. However, management also acknowledges that declining profitability indicators may necessitate a reassessment of investments and operating strategies to improve business performance. Management is actively engaging with Paladin to jointly develop the PLS project, indicating a focus on strategic partnerships to drive growth. Overall, the company's strategy appears to be centered around capitalizing on growing demand for natural uranium while adapting to changing market conditions. The company has made significant moves through acquisitions, while maintaining a stable portfolio through divestitures. Notably, Orano and Navoyuran have partnered to develop the South Gingeldi uranium project. This strategic partnership marks a key acquisition for the company, expanding its capabilities in the uranium sector. The company has a history of paying out dividends to its shareholders. In fact, it has explicitly declared and paid dividends in the past year, with a total payout of $53,205. This indicates that the company is committed to returning value to its investors through dividend payments. Concerns over inventory buildup. A growing issue for the company. The company's financial summary reveals a pressing concern regarding inventory buildup. The average days sales of inventory has increased significantly from 44 in 2024 to 199 in 2025, indicating a substantial accumulation of stock. This is further exacerbated by rising selling and distribution expenses, with storage costs of natural uranium inventories increasing by 51%. Moreover, the cost of sales has also seen a notable increase, from $955,475 in 2025 to $4,129,084 in 2024. The company's inventory buildup is evident in various financial transactions. The cash repayment for inventory lease amounts to $534,170, while $191,246,000 is due to a joint venture and an associate of the company. Additionally, $177,306,000 was received as cash in an inventory lease arrangement. While there are concerns about inventory buildup, there are no indications of supply chain disruption, suggesting that the issue lies more with inventory management rather than logistics or distribution. That concludes the financial summary for Cgn Mining. Feel free to comment below, and I will be happy to answer them when possible.